panelists to the stage. This panel, number 2, is on what makes a spin-out and an emerging manager attractive to investors. So as we have the last panelist exit, we just want to give them a chance to leave the room in case anyone wanted to connect with them, just so we can keep the event flowing. We'll need to do that for all the panelists today, so appreciate cooperation on that. We have this panel now, one more panel, and then we're going to have a full hour catered networking lunch so you can get to know each other. I know that's the main reason you're here today. But also we found it's one of the most productive ways to have you connect with the people who are most appropriate for you to be having lunch with or talking to during cocktails by having the investors here on stage today and hearing what they're looking for so that you know out of the whole room of people what 3 to 4 groups are most aligned with what you're looking to get done in business. Great, so we're going to go down the line now and have each person introduce himself. And if you can keep it to just 1 or 2 minutes each, that'll help keep the event moving along. And right before we jump into that, I just want to point out one thing, is that on the last panel there was a comment that I ignore a lot of the 800 emails that come towards me if it's not through a trusted referral or it looks like it's someone that is high trust, that has a feeling of high trust around it. And I think that's really critical because a lot of times people hear, oh, referrals are the best way to do business, but if you're here trying to get progress and get traction in the family office space, maybe you only have 1 or 2 referral sources. So I think how do you position yourself and add value first so you have that position of high trust is critical to this whole process and everything we're talking about and working with family offices. So Charlie, why don't you start us out and let's go down the line 1 or 2 minutes each on your perspective and your firm.
Sure. Yeah, just a short introduction. Hello, I'm Charlie Liu. Grew up in China, came to the States for college, and probably had the shortest career among everyone here. I started my career in investment with Franklin Templeton in the global macro team. If some of you invest in other asset classes, I was in the team of Michael Hasselstad, and so I joined the team at the peak of Ireland trade and then left before Ukraine, so good timing. And then pivoted to fintech, joined back then no one heard of it. It's a fintech company out of Amsterdam called Adyen. We process payments for the top tech companies around the world, Facebook, Netflix, Spotify. And then on the at the sideline, I'm doing some angel investments and also entrepreneur on my own, sommelier, winemaker, and then also starting a stealth mode startup now.
Great, thank you.
I'm Urvashi Bhagat. I have broad background in healthcare. I started out on healthcare insurance side, and then I experimented some with the biotech pharma side, and now I'm in the nutrition prevention and wellness side because actually I was very frustrated with how the pharma side is working and how the insurance side is working. In the sense that we are not preventing problems that we could be preventing from ground up, and the entire system is structured in rewarding treatment. And so I found that to be a big problem. And so I'm motivated by solving wellness problems from ground up through bigger solutions, so broader solutions. I'm not interested in this is a new nutrient, this is a new supplement, but how do we solve the problem overall? So I founded a company, Asha Nutrition Sciences. I have been a founder before, and so we have this Asha Nutrition Sciences that is solving some problems at ground up, and that's the kind of investments I look for that are solving problems on a broader level.
Great, thank you. David?
Morning, I'm David Mess. I'm a venture capitalist. I've been in the venture capital game for about 20 years, investing early, late stage, depending on where I was in my career. Right now I run a firm called Off the Grid Ventures, which I started about 2 years ago. So I'm an emerging manager, hence my presence on the panel. And I'm also a co-founder of the Wharton Alumni Angels of Silicon Valley.
Great, thank you.
My name is Masha Drokova. I'm angel investor and general partner at a venture fund called Day One Ventures. I invest in early stage companies in B2B and consumer space, AI, fintech, emerging tech, and we invest in companies and support them with PR. And my background is PR. I did PR for WeWork, House, Hotel Tonight, Get, and many companies which grew from early stage to unicorns.
Great. Darren?
Yeah, and good morning. Darren Kaplan. I was the founder of a hot HR tech company named HiQ Labs. I then went on to start a venture fund with a couple Google and Apple operators. This is our Fund 1. And we studied the space and we looked at how much money early stage rounds are, like $2-3 million seed rounds. And we then started to look at how many of those companies fail. So we're applying an early stage PE model to a real early stage. Our first company goes live in October. And it was, again, based on that model of looking at very smart people that built individual technologies but didn't look at market. And we've put them together and starting a productivity company. So thank you for being here and happy to answer your question.
Great. So Darren, in your case, how do you differentiate taking the private equity approach versus a VC approach when you're working with the early stage companies? Like what's really distinguishes you from others?
On which part? Deal flow or raising money?
How you structure the deals how you structure your investments.
Yeah, I think for us on this fund, we spent a lot of time researching and looking at Larry Culp and his beliefs of roll-ups and bolt-ons. So for us, everything we're engineering is based on an exit strategy. And I think that's where I think we're more aligned with PE because we're looking for deals that we can put together, then exit versus IPO. And there's a ton of money out there, and there's just not a lot of good deals out there.
Sure. Great, thank you. So I want to go down the line with real quick, kind of maybe 2 or 3 minute at most case studies of an early stage investment that you have made and how you sourced the deal, valued or structured it, whatever the most interesting component is it. Maybe it's an unusual way of sourcing the deal or a great structure you came up with. And maybe we'll start with you again, Charlie, and just work our way down with one example each.
Sounds good. I'll just add some interesting stories. So the most interesting deal I made was I got to know this founder at a random wine tasting trip in Chile, in Cochaca Valley. He's a serial entrepreneur, so built and sold to security companies and starting this smart wine machine. Right now, as we just closed B round last year, and then right now doing very well in hotels, luxury hotels around the world. Just interesting in the sense that, coming from a sort of public market and sovereign credit market investor, the way I was trained, it was just always looking for the alpha. There's so many beta around the world, and to find alpha, you need to find that edge, and then which means that you need to set up your comfort zone and go to places you've never been to and meet people you've never met with. And that's how actually, how I see it with so many friends around me who has some career in investment banking and then later in VC and now try to be building up their own funds and try to be emerging investors. And most of them coming from this traditional investment background, probably like some operational experiences and scaling startups. So try to find someone who can differentiate from those kind of people who have sort of really strong independent thinking and dare to be the contrarian. I think that's really important.
Right, great. I think a lot of family offices get the biggest returns when they're arbitraging some big inefficiency and they get in early, like Peter Thiel's famous for doing, and just double down where there's empty space versus just following the herd into things. Urvashi?
Thank you. So like Charlie, I'm also very focused. I'm myself focused, and I look for founders who are focused. And I'm always 99% of what I'm trying to do is what problem are you solving? So the bigger the problem you are solving, the foundation up you're solving, that's what's most interesting to me, and how focused you are on what you're doing. So that's 99% for me, and I stay within my area, which is health and wellness, because that's where I find I am the most competent, and that's the kind of competence I'm looking for in founders. n- Drive to make money is good, because unless you can do that, you can't succeed in what you're doing, because you have to build upon initial success and so on and so forth. But the goal is to solve the problem. That's what I'm looking for. That's what motivates me.
Great, thank you. By chance, through Centimillionaire Advisors, we just signed a healthcare family, and just like you, not only are they focused just on healthcare, but then also real estate for them, is they're looking for something that's going to help transform and push forward the healthcare space. They just feel like it's so broken. And I'm hearing that again and again among really smart healthcare people. I think a lot of people gravitate around how big of a problem that is, not an impact investor lens, but just that big profits could be made while fixing a broken system, basically.
Absolutely. I think it's a huge problem that we don't pay attention to the fact that we are motivating treatment. So if you're going to pay $10,000 to someone to perform a heart surgery, then they are going to perform a heart surgery. I think the system is fundamentally broken, and we have to fix that.
Right, great. David?
Yeah, so when I arrived in the US about 15 years ago, I ran into these type of issues. The other thing that frustrated me majorly was to be treated as a financial pariah. It was impossible to get a credit card. Everything was very, very difficult. So when I ran into a founder that set out to solve that exact problem, it took all but 30 seconds to know that I wanted to pursue this if the founder checked out and we could do something about it. So we invested in a company called Credit Stacks that provides credit cards to immigrants that come to work on work visas for qualified jobs in companies such as Google, LinkedIn, et cetera, et cetera. They use AI to assess somebody's credit risk. They don't need to rely on any credit scoring or anything like that. And so they're able to penetrate the market, going to these companies or relocation agencies and really grow. And when you see how the numbers tick up, it's a phenomenal business. And the only reason why I ran into it is because I knew the problem deeply. And when I met the entrepreneur, it was instant connection.
I know there's a huge opportunity in consumer lending to underbanked or underserved or alternative financing, whether it's lending or just banking services. It's a huge opportunity right now.
Yeah, it is. It's a huge opportunity in the parts of the market that really have no access. Most of them are reasonably low-income people and so on. And unfortunately, they get abused by, how should I say, glorified sharks,
Sure.
lending sharks. In this case, it's really the pre-prime market. It's people with prime market risk, and yet who don't have access because of where they came from. And that's a fantastic market opportunity.
I heard there's one lender that gets your permission to track data sources and app usage on your phone, and it uses 500 different data points of where you live, where you go, how late you stay at night, what you're buying, et cetera, and those 500 data points and uses like AI to give you like a score of how risky of a person you are to lend to. And I think there's all sorts of innovations going on in that area that's pretty exciting.
I can't comment on details, but I see what you're saying.
Great, sure, yeah. Masha?
I look very carefully on what customers think and say about the product. One of their investments that we made early is a company called Superhumans that recently closed Series B with Andreessen on 263 million post, and it's grown very fast. And I was paying it's an app that creates the fastest email experience, and they sell it for $30 per month, and it's premium experience, and you basically go through your inbox 3-5 times faster with the help of their technology and with the help of their features. We met this founder through another portfolio founder, and it was three things. First thing was just the way how customers speak about the product, and you can go to Twitter and you can see dozens of people raving about the product, and they have 180,000 people in their wait list. Another thing is experience as a founder. One founder had a successful exit before another founder exited the company for more than $300 million, and they're still in their early 30s, and they have successful background. And number three is culture. You could look at the culture through the language that people use with each other and with you, and you can ask indirect questions to understand better the culture, and it's good if you go to the office of the company and see other people, see the vibes, see how they interact with each other. These three things been criteria: culture, customers, and experience of the founders.
Great, thank you. Darren?
So for us at our fund, we took a different approach. We play 0 to B, so that's kind of that framework. not afraid of money, so I'm not worried about valuation or check sizes. But for our aha moment, again, came from all of these early stage companies dying and coming to us when they have 90 days of cash left. And I love that, because I'm going to come and buy you for $1 on the 91st day. Because what I look for is fundamentals in how did you get to your product. And I think most founders, I feel, do not spend enough time understanding their customer. So we spend a lot of time on process and discovery. We record, we look, and we constantly build out that community. So when I see early stage 0 to A, and I could look at a product just like all of us, and we all can just look and be like, they overbuilt this. And this is a swing and a miss. But the way I look at it is like, oh, great, you know data security? Great, I'm going to buy your company for $1 because I need just you. I don't need your code. I just need you as that data security and some of your insights, because you spent 18 months figuring out something that at the end of the 18 months, nobody wanted. But if I take that and I put that with your productivity tool that you didn't figure out because you didn't do discovery and you overbuilt, I take you and you, but I have a list of things we want to build. So I just look at it as poor discovery. I look at words like serial entrepreneur, and I feel like that's a fail. I don't think, because the people I know, they hit their home run and they're in Hawaii. The people I know that say I'm a serial entrepreneur means they started 7 companies and they still have to work. That's not a serial entrepreneur. So I look at that as more as a negative than a positive.
Great, thank you. Yes?
Can I make a comment about Masha and Darren? I think what you're saying is absolutely right, that you want to see what the customers say about the product. But I think there's a caveat that sometimes customers don't know, and they have to be taught.
I don't agree with that. The issue with that is it's poor discovery. It's been proven on how to ask questions and bring people through a journey. I agree at some point that people don't know what they want, but the founders don't know how to ask questions. That is the problem.
I think it depends on the industry. Sometimes in some industries, some markets, there is a long development cycle.
But again, you get out of that development cycle in 18 months and no one wants it. Whose fault is that? Like, and then I come in and buy you for $1. But I'm gonna push back, because I think it's a fun panel to push back. But I put it back on founder. Again, I run teams that are technical data science, sales, growth, and I love your background. So I can go the range of sales to data science. The teams I build are all PhDs from Stanford, MIT. But I still think that each one of those groups need to understand how discovery works.
Yeah. The field that I am in, it can take a decade or it can take 2 decades to come around to understand the depths of what we are talking about. Many, many scientists coming from National Institutes of Health, worldwide scientists, have failed to understand lipids for last 2 decades or last 4 decades. They have taught low fat, high omega-3, and everybody has now turned around. So it took so long for the scientists to understand it. How do we expect the general public to understand it?
But on that, I've studied that space, and I think that's a bigger problem. The government messed that up as well. If everyone looks at the food pyramid in the 1990s, every college girl, when they wanted to lose weight, said, I just want to eat white rice and chicken. Now you give a girl a carb or a guy a carb, they're like, that's a fat. So I think that's a bigger problem than academics.
Exactly, I agree with that, and that's my point, that if the government has failed to understand and has misled people for several decades, how do we expect Joe Blow to understand? So it's going to take time to educate the Joe Blow.
Great. Great. So I want to go back to a question on the last panel about financials and how much projections matter. I think one challenge for some private investors maybe here in the room is that if they're running a family office and acquiring companies, maybe on a multiple of EBITDA. They might pride themselves on getting 4 or 5 times EBITDA. Maybe they pay 6 times EBITDA sometimes for companies. Those are really common multiples. And that might mean that they're paying a multiple on revenue that's much, much lower than a VC or a fast growth company from Silicon Valley, et cetera. A lot of times people look at pro formas, and they're never bad. The projections are always great, right? Even the conservative ones are great. You're not going to show an investor, oh, we might fail and lose all your money, and that's scenario A. That scenario is not shown on the slide. It might be talked about, but the challenge for a lot of family offices when investing in VC, I found, is that they look at a company that's some idea and some programmers, and they give themselves a $5 million valuation. How else do you raise $1 million and not give up all your motivation? And meanwhile, the company they just bought with $1 million a year of EBITDA, they just bought it for, $5 million, which they can grow rapidly because they know that space. It's not like there's no growth prospects for it, or they wouldn't be buying it. So if there's investors here in the room that have this challenge of valuing early stage companies, I wonder if a few of you that have seen hundreds, like David with the Wharton Alumni Angels, you probably see a lot of deal flow from that. Darren, it sounds like you look at a lot of deals. How do you go about valuations? How much weight do you put on the projections? And what advice would you have for private investors trying to navigate all of that?
Sure, happy to start there. And I've seen thousands of deals. I think when it comes to early stage investing, really the valuation of a specific deal is not what matters most. What matters most is your overall discipline in not overpaying for deals. I think that's really the way to look at it. Because when we think about valuation of an early stage deal, the important part for us is to make sure that we keep every party incentivized and that the incentives are aligned. Meaning, of course, if you buy a company that has 0 revenues, there is no multiple, right? If you buy a company that has very limited revenues, is growing fast, there is also no multiple that could apply there. What we want to make sure is that we know what the company can grow to, and so we imagine exit scenarios, and from there we derive what we think our multiple on investment is going to be, and we look at whether that's commensurate to risk. So that's really how we run it. We run it results-based, and not so much, hey, this company is really worth X today, because that is really a very subjective call.
And do you find with your angel investor group, when people come in and pitch, that many have overly lofty, we're going to capture 2% of the market, so we think our valuation is really big? Or do you find that most people have pretty conservative estimates, and that's not a back and forth trouble point with negotiations?
No, any good entrepreneur would be a wild-eyed optimist anyway. So we don't give too much credence to what we see in the numbers. We try to derive our own perspective and build our own scenarios and then work on that.
Sure. Okay, great. Anyone else want to comment on valuation?
Since I was asked, I think for me, and if we look at family offices, no different than venture, although I'm here and I don't have a CPA, but behind me at our organization, we have economists and PhDs that run numbers. And we just like to see, when you crank it, what does the output look like? So for us, we want to see quarter over quarter price increasing. We want to understand how you think about pricing. We want to understand how you force to scale. And then we see everything that's failed, so it's easy to see where they missed. And a lot of the time is they don't charge, and they don't know how to scale to even get to those valuations.
Great.
There's something I could add, because it's the next thing in that logic, which is really when you look at the venture capital world today, some people worry because they see very fast inflating valuations. Late stage valuations are completely insane. Actually, Series B, even Series A valuations are sometimes insane. And so in our game, actually, if you invest very early, there's actually a fantastic arbitrage to be made, right? Of course, stay disciplined, try to invest at an average of 5 million pre, not 10 to 15 or let alone 20. But if you do those early investments, you can even exit some of your positions through secondary transactions at the Series B or Series C and make between 20 and 50 times the money, because the market is way overinflated, because the entire industry has been pulled up by funds that are bigger and bigger, right? And so that's also something to keep in mind.
Great. Masha?
I think we mostly trying to look at opportunity, and if it's something that can grow very much, we're trying to look at companies which has on the big market with good product experience and have capacity to grow over 10 billion or a little bit less. But I think most of the deals that we do, there is some lead investor, and most of the deals we do, there is a lead investor who was in competition with 5, 6, 7, 8 other lead investors. offered some term sheet, and entrepreneur chose this lead investor. And it's usually very good, very competitive deals, and it takes effort to be a part of this deal, and it takes effort and right strategy in terms of your check size and in terms of your value add to be part of this deal. So in most of the cases, we are in the rounds where it's other big, large lead investors, and we take not majority of the round, but I agree with this valuation. If we come to the entrepreneur when she's not raising round or when it's early, we're trying to give fair market price. I would be like afraid of very good deals. It's usually indicator of the problem. We'd rather go after deals where we see great opportunity versus deals which are just at a good price, but where you take too much of the risk.
Sure, great. Any other quick comments on this one?
Yeah, I look for size of the market and the hook. Do you have intellectual property that gets you a proprietary position? Then the valuation for me goes up.
Sure.
I think it's always a good balance between the vision and the founder. To some extent, I agree with what Darren said, like how much you believe in that founder, that person. Because the thing with early stage companies that there's always going to be another pivot in the maybe even the next week or the next month. So in 3 months, the company you're looking at is totally a different company, right? Interesting case last year, Luckin Coffee in China went from founding to IPO within a year. And they raised so many rounds within that year. So each month, the company is a new company. So it's always good to balance the vision and the pricing.
Great. And then I open up for questions in just a minute here. But I just want to go through, if you could say in one sentence exactly what the most valuable type of deal flow you would like to get from the event here today, then we can help you make those connections here in the room. Darren, why don't we start with yourself? What's the type of company? We know you like ones that have gone bust or are distressed. That's part of it, obviously.
For our thesis is all about something called future of work, and that means automation. So we look at productivity, not the software part of it, but think about the automation part. So think of big software and all the gaps that need to be automated. So that's what we're looking for. So if there's deal flow like that, very interested. And if there's people that also are looking to invest, we'd love to speak to those as well.
Great. Masha?
We look at early stage companies obsessed with their customers, which use their time and effort into learning as much as they can about their customers, where customers cannot imagine their life without using the product that company produced.
Great. Thank you. David?
So we invest in seed stage companies in the technology arena, but specifically we back entrepreneurs that are either female founders or foreign founders of companies. So that's what we look for.
Great. Thank you.
So I'm looking for solutions to broader problems in healthcare, and I'm looking for teams that are focused and they have some kind of hook, intellectual property patent. The stronger the patents, the better the deal for me.
Great.
I'm looking at projects and investors who have a really keen understanding of long-term macro trends like demographics.
Great. And we'll walk a microphone over to you. If anyone has a question, please raise your hand. We can call on you. Great. 1 minute. We'll bring a mic over. Alan up in the front here. Oh, thanks, Charlie.
Hello. Okay. Something struck me about what you said. You were talking about in the beginning that your group is really focused on metrics. And so the question is what is the single most important metric that you're looking at using your analytics, let's say, okay? So what is the most important factor in the success of a company, a startup?
Yeah, so for me, I like playbooks. I'm a playbook guy. I've studied Ray Dalio's principles. And for me, it's pain, reflection equals progress. So for me, I look for the pain. I look for how they've reflected and the progress they made through it. Because if you're failing, it's either you, your product, or the market. So I need to dig into those three. I think you can go any stage. So that's kind of what I look at. And then I can layer each way.
So there's a lot of metrics out there right now that are talking about timing. Like if you look on YouTube or look at some of these research that's been done, like at Stanford, they've been talking about the role of timing and all of that. So is that a component of what you're looking at also?
If I had to weight all of the metrics, timing is probably the least weighted. That's just God smiling on you. You just built it and you got it there. I think when I look at timing, when I look at a lot of deals, I think a lot of people are building for today, and they don't realize that in 3 years is when you'll be ready, and hopefully your product is ready for 3 years. But I'm constantly just looking at pain, reflection, how did you break through it, how did you break through it? And then you'll have
Great, thank you. I think we have time for 1 or 2 more questions. I think we had one on this side. Yes, Jason, we'll bring the mic over to you. It's millennials these days.
Okay, that's interesting. That's interesting. A little bit Hollywood here. Hey guys, great panel. I'm going to ask the same question that I asked the last panel, Jason Ma, because I find it to be a bit of a revelation, right? So there's one thing that you like to improve on personally or professionally, or was not working for you. What would it be?
Maybe we can have 1 or 2 of you that have the most interesting answer.
I could start if you want. I don't mind talking that much. I love that question. When I mentor founders, I talk to founders, I ask them the same thing. So for me, I believe as a belief of self-audit. And one of our investors in my last company is Gary Vaynerchuk, and his belief system is understand your strengths, understand your weaknesses, and go in all in on your strengths. And for me, when I did my self-audit, strengths, weaknesses, the thing that really just came back the most is really have the self-awareness to understand the difference between listening and hearing, and let people finish their question before you think that they're asking. And so just for me, just a lot of self-learning and understanding the difference between listening and hearing and the layers of that.
Great, thank you. And I just realized if a few of you are blocked by the podium, we have plenty of chairs that are not blocked by the podium. If you actually want to be able to see the discussion panelists better, feel free to migrate this way after this panel. Does anyone else want to answer that one?
I wouldn't say not working. I would just say there is a space where I'm digging more into. We are very hands-on and very value-add. We have team members which are full-time working just to serve portfolio companies. And the better work we do with them on PR and marketing sides, the more of our time and our attention they want. And like when our portfolio founders raise new rounds, I'm literally like sometimes copy editing the emails to investors. It's just like doing lots of actual work which are loved by the founders, but you cannot serve like 50 companies equally well, right? And it's a question like, but on the same time, if you invest on very early stage, I think it's like dangerous to make like less than 10 investments every year, because otherwise it's just likely not going to work in terms of economics. So it's a balance between making good enough number of investments and then keep and stay hands-on, and we finding that we can build up internal procedures and we can learn how to be helpful and how to make it more scalable, and on the same time what kind of parts we can optimize. So everything you do for them, for example introductions or work with the media, you have reputation on the way that every introduction you make will be taken, and everything you do for them will lead into something, will lead into the deal, will lead into publication, will lead into the person who hired. So it's a question like how to balance this, your involvement and the amount of companies you need to invest in order to be successful on early stage.
Great, thank you. We're just about out of time. We literally have a minute and a half left at the most here. So does any one of you, though, have something you just really wanted to make sure you got in on the panel that you wanted to share with the audience today, like a last closing thought?
Maybe I want to rebound on the question just before, which is, when we look at deal, the most important thing to us is the team. We look at everything else, right, like Darren does, but really the team makes a difference, because if you're too early to market, the market is not right, and so on. You want a team that recognizes fast, that pivots fast, and then that executes well too, right? So a strong team is really the key. And we spend a lot of time looking at that, both personally, but also using AI to analyze people's personalities and understand what the makeup of the entire team is.
Great, thank you. Anyone else?
And to the question of what we can improve on better, personally, I think it's widening my horizon. I think I pride myself to be pretty familiar with the US ecosystem and the Chinese ecosystem, and the fact that I'm working for a European company, I'm fairly familiar with it. But recently I took a trip down in Latin America in so many different countries, and the ecosystem down there is so interesting. So there's always a blind spot. Maybe it's Middle East, maybe it's Africa, so keep your eyes open.
Great.
I would say when you start working with entrepreneur, I would look not just on valuation and market size. I would look at the person and think about, can I imagine seeing this person in my life in 10 years? What I see is the deeper your relationships, the longer you knew each other, the more opportunities you bring to each other and you grow together. And I think it's really important to not get blinded by valuations and by markets, and just ask yourself a question: do I actually want to work with these people for many other years? Because looking back, I just see all best opportunities came from entrepreneurs we wanted to work with. And I think for an investor, there is no better assets than the reputations that you have in founders community.
Great, thank you. So we're going to break now. Before we give them a round of applause, though, we're going to have the panelists exit the room. We're going to have the panelists exit the room before people try to network with them. We'll give you a round of applause before you exit, though. And then we'll have our next panelist come up to the front stage. It's going to be a resilient real estate discussion panel. Everyone knows we're not early in a cycle, but no one knows what's going to happen next. We're going to talk about real estate investments and what people are doing right now in their portfolio, deals are closing, et cetera. So with that, let's give our panelists a round of applause.